Alright folks, buckle up, because today we're not talking about Wall Street, we're heading east, to Japan. And what's happening there isn't just alarming, it's dangerously close to a full-blown economic crisis. As we discussed in earlier videos, if you want to see what is going to happen in the bond market, you do need to follow Japan, not the Fed. While US markets are wobbling, Japan is entering emergency mode. This matters more than you think, because it exposes two terrifying truths. 1. The bigger your debt, the faster your economy unravels. And 2. There's a limit to how long you can borrow before it all comes crashing down. Japan's debt-to-GDP ratio is off the charts, a staggering 240%, meaning they owe 2.4 times the value of their entire economy. That's more than double the US, and here's the kicker. If interest rates rise, it's game over. Higher rates make debt payments explode, leaving less cash to reinvest, rebuild, or survive. And guess what? That's exactly what's happening. Japan's 30-year government bond just crossed a 3.15% yield, the highest level in over 3 decades. That's not just a number, it's a blaring red siren. When bond buyers demand higher returns, it usually means one of two things. Either they fear inflation will eat their profits, or worse, they don't trust you to pay them back. In other words, markets are whispering something terrifying. Japan could be headed toward default. And the fallout won't stay in Japan. The Japanese yen is a global reserve currency. It's deeply tied to US markets. So if Japan's economy unravels, it could spark a cascade effect across the world, including a potential implosion in US bond markets. And it gets worse. Japan is staring down a full-blown recession. In the first quarter, their economy contracted by 0.7%, and this was before the latest wave of Trump-era trade tariffs hit. Japan has already endured 3 quarters of recession in 2023. 2024 saw a brief recovery thanks to a weak yen, but that's fading fast. Here's what we're seeing now. Private consumption, flat. Exports, down 0.6%. Imports, up 2.9%. And remember, imports subtract from GDP. Business spending, up slightly but likely unsustainable. Worse, Japan can't count on its own people to save the economy. Their population is aging at breakneck speed. By 2045, the working age group, those aged 15 to 64, will shrink to just 52%, while nearly 40% of the population will be elderly. With no meaningful immigration to boost growth, Japan is heading into a demographic cliff. And the financial pressure is only mounting. Japan's fiscal deficit is expected to jump to 3.6% of GDP in 2024, up from 2.9% last year. Inflation is soaring, currently at 4%, higher than both the US and Europe. So, the question arises, why doesn't Japan just stimulate the economy, print more money, spend their way out of the crisis? Because they can't. They're trapped in a vicious cycle. More spending fuels inflation, but raising interest rates to fight inflation makes their debt more expensive. It's checkmate, a classic debt trap. And after 13 years of the Bank of Japan buying bonds to control yields, they're now reversing course, starting to sell those bonds in 2024. That's a major gamble, because the biggest buyer of Japanese debt is walking away right as inflation surges and a trade war heats up. Speaking of trade, this is where things go nuclear. Japan cannot afford US tariffs, especially the 25% import tax on steel and autos. Their economy depends on exports. Margins are razor thin. If the US keeps pressing, Japan will have no choice but to retaliate. And they might just do it by unleashing their secret weapon, $1.1 trillion in US debt holdings. If Japan starts dumping US Treasuries, it would shake the global financial system. Here's what that could do. Crash the US dollar, helping Japan tame its inflation. Lower energy and food costs at home, since 90% of Japan's energy is imported. And it would free up cash to buy their own government bonds, pushing Japanese yields back down. On paper, it's genius. In reality, it's a nuclear option. Because selling treasuries would also strengthen the yen, hurting exports. It would spark panic in global bond markets, and spike yields in the US, worsening our own debt crisis. The US is already teetering. Our debt to GDP is projected to hit 107% by 2029. Deficits are exploding. And now Japan, America's largest foreign bondholder, might pull the plug just to survive. This is why the Japan-US trade deal matters more than ever. Saving Japan might be the key to saving the US. Let's be clear, if Japan's bond yields keep rising, they might be forced into desperation mode. The Japanese yen carry trade, the old strategy of borrowing yen cheap and buying US assets, is breaking down. Investors now have a safer, more profitable option: buy Japanese bonds directly. 2-year yield, just 0.7%. 30-year yield, over 3%. And best of all, no currency risk. That's devastating for US investments. If capital stays in Japan, the US could face an exodus of money and falling asset prices. And yet, the US seems blind to the danger. Scott Besson, defending the strong dollar, argues that it's about capital flow confidence. But how can you inspire confidence when your biggest creditor is being pushed toward financial collapse? Trump's administration is playing hardball with everyone. Tariffs here, ultimatums there. But if we push Japan too far, they may go full China mode and push back, hard. And they have leverage. If Besson insists on a Plaza Accord 2.0, forcing Japan to strengthen the yen, he could nuke their export economy. In return, Japan may nuke our bond market. So here's the question for all of us. Will Japan sell their US bonds to survive? And will the US keep pressing its luck? Let me know in the comments. Smash that like button, subscribe, and stay sharp. Because what's happening in Japan might just be the fuse that lights the next global financial explosion.